Consumer elasticities have largely held up better than expected year to date.
We continue to expect more elasticity.
Price elasticity is a hot topic in earnings calls during periods of high inflation, like the one we're in now. When inflation is high, companies raise prices, and consumer spending usually slows. As you can see here, consumer spending has held up relatively well so far, despite the highest inflation in decades. But experts say we're finally reaching a turning point where consumer spending is beginning to slow. And that's where elasticity comes into play. Here's how price elasticity works and why so many companies are talking about it.
How much does demand for something change when the price changes? When something's elastic, it means if the price goes up, demand falls. That's not a great thing for companies because then they have to worry about that any price increase will really affect demand.
Here's the chief commercial officer of Southwest Airlines talking about this idea in the company's second quarter earnings call.
Leisure travelers have a price elasticity effect where you can't go much higher.
What companies want is for their product to be inelastic, meaning a price increase doesn't really impact demand. Elastic products are usually non-necessities like perfume and staples. Inelastic products are typically things we really need and that don't have many alternatives, like groceries and toilet paper. But there are some exceptions.
What has proven inelastic, particularly around the pandemic, has been branded household goods. In past kind of bumpy economic times, people have switched or traded down to cheaper products around the house. A lot of people who really watch the industry have been surprised by how much people are willing to continue to spend on these household basics.
Gym memberships are also inelastic right now. For example, Planet Fitness raised the price of its Black Card membership in May, bringing the monthly fee for new members up from $22.99 to $24.99. And the company said in August,
"We haven't seen an initial dip in our Black Card percentage rate as we did with the past price increases."
COVID has eased up. Everybody's kind of making up for lost time. They're wanting to get out. So they're spending on travel. They're spending on experiences, on movies, on eating out. And it's been a really big shift from goods to the service side of the economy.
Several factors affect a product's elasticity.
It's the necessity of the product. So how important is it? What's the competition like? Are there a lot of other options? Some of it's just emotional. Some people really believe a brand is a lot better than another brand.
Elasticity also depends on the price range of the product itself. If it's a low-cost item, a slight increase in price matters to consumers. If it's a more expensive item, then a small increase isn't as noticeable. These are examples of what executives consider when they talk about elasticity.
What executives say and think about elasticity matters a lot to consumers because ultimately their assessment of what consumers are willing to pay will drive their decisions on how much to charge. Last year, when CEOs were talking about elasticity, they were more saying, wow, like everything's inelastic because consumers are just willing to spend.
Now, prices are still going up because of inflation, but demand is starting to go down, so certain products are becoming more elastic. Unilever, Procter & Gamble, and Kraft Heinz each reported lower volumes in their latest quarters, meaning people purchased fewer brand items amid higher prices. Many retailers have lowered profit expectations for the year and are cutting costs as consumers are pulling back spending in categories like apparel and home goods.
During the quarter, Macy's brand customers across all income tiers slowed and shifted their spend.
In recent weeks, sales of premium detergents like Tide have been on the decline, according to industry data.
After all this time of sticking to this very high-end detergent, consumers are shifting to cheaper detergent.
P&G executives said they believe Americans will keep spending on household products even if inflation and the overall economy worsen. So how can companies like P&G maintain market share when their products become more elastic? One strategy is to promote the cost-saving benefits of their products.
And it'll save you up to $150 a year.
And it's cold.
There's a version of laundry detergent that you can use in cold water. So the detergent isn't less expensive. In fact, it's even more expensive than it was 6 months ago. But they say, hey, but the money you're going to save on not having to heat your water makes this detergent overall more cost effective.
Another strategy is to offer smaller-sized products at lower prices to appeal to cash-strapped consumers.
So if you only have $10, you can still get, your name brand detergent. And that's something that consumers who don't have as much money do, sometimes out of necessity. It also means they're actually paying more for each, quantity of the product because the less you buy, the more expensive it is.
A P&G spokeswoman says the company has always offered various package sizes to meet different consumer needs, and those sizes vary by retailer and market. Kraft Heinz takes a similar approach by offering $1 Lunchables and lower-priced packages of Kraft Singles cheese with fewer slices. Companies also have the option to lean on retailers to get more shelf space or improve the presentation of their products in the aisle. While inflation slowed a bit in August, underlying price pressures and wage growth suggest it could run well above the Fed's 2% target for some time, which is why industry leaders are keeping a close eye on the labor market. The idea is that as long as people stay employed, consumer spending will likely remain solid. But supply chain disruptions and consumer demand have both shown signs of easing recently, which economists expect will slow price increases for goods. So the dilemma for many companies now is whether to raise prices or cut costs.
When do we start laying off workers so we don't have to raise prices? Depending on the industry, some companies are there, some companies aren't there. So I think figuring out when that happens is where a lot of companies are right now.